term would say it's virtually non-existent. And so I know that a lot of you in the front and the back will not be able to see the slides. That's okay, because I'm going to present in a way that you will not be disadvantaged even if you cannot see the charts. If you can't see the charts, terrific. If you can, don't worry about it. I don't think there'll be any loss. I will try to leave some time at the end for questions and answers. I know the hour is quite late and you've just eaten, and so I'll try to be brisk in my presentation and keep it upbeat. But ultimately, I want to address the question that you all have, which is how long will this last? Because many of you are significantly busier than you were a few years ago. Some of you are actually profitable again. And so the question in the room, how long will it last? And we'll get into some of those issues. I've entitled the presentation, The Economist Who Loved Me. The theme is James Bond. It's based on the 1977 spy thriller, The Spy Who Loved Me, starring Barbara Bach and Roger Moore, and also featuring a theme song by Carly Simon, Nobody Does It Better, which is arguably one of the 5 greatest songs of all time, not produced by Queen, Rush, or Led Zeppelin. I'm going to start very broadly, first with a primer on the global economy. I'll quickly taper down into national level economic data. I'll then share with you data specific to regions around the country, with of course a deeper dive into Virginia data. Thank you so much, AGC Virginia, for inviting me. I'll then conclude with the forecast for the balance of 2016 and beyond. I'll talk about energy markets, financial markets, labor markets, real estate markets, all those markets before we are through. And then we'll have some time, hopefully, for Q&A. So let me begin with that primer on the global economy. And I think one of the things you have heard is that the global economy continues to be quite disappointing. We are not quite through 2/3 of the calendar year, and yet already the World Bank, the United Nations, and the International Monetary Fund have downwardly reduced their economic outlooks for global economic growth in 2016. In fact, the International Monetary Fund has not done it once, not twice, but 3 times already. Here are the standing forecasts for global economic growth in various parts of the world. I won't, again, because the type is small, I won't spend too much time on this, but the outlook for growth in Europe is around 1.6%. That is, in fact, the outlook for the Germans. The outlook for the French is worse than that. For the Italians, worse than that. The Spanish expected to do a bit better. The outlook for Canada is for 1.4% growth, though, of course, nobody cares. And then the outlook for the Americans is 2.2% growth. And even if you can't see the chart, it should be apparent that relative to the balance of the developed world, the advanced world, meaning Japan and Europe and the most developed societies on the planet, that's actually not horrible performance. In fact, 2.2%, and again, that's just a forecast from the IMF for the United States for the current calendar year, but at 2.2%, that's actually one of the better performances in the advanced world. And I'll talk about the salience of that much later in the presentation. Some of the most interesting stories come from the emerging world, which is sort of the bottom half of the chart. There has been this emerging narrative suggesting that the so-called BRIC nations, Brazil, Russia, India, and China, would supplant the United States as a leading engine of global economic growth. That actually has happened to a degree, but not nearly to the extent anticipated, and that's because many of these emerging societies are posting very disappointing growth numbers. Take, for instance, China. The official outlook or forecast for China this year is for 6.6% growth. That society grew 6.9% last year. That doesn't sound so bad, but that's the weakest performance for the Chinese economy in 20 years, and that's if you believe the data. Because there are certainly many people who think that the Chinese are not growing anywhere near 6 to 7%. But these are the official data, and even if you believe the official data, that's the worst performance in a couple of decades. What about the Indians? Well, the Indians are doing just fine. That economy grew 7.3% last year, expected to grow 7.4% this year. Among the BRIC nations, that is easily the best performer. But then there's the Brazilians, much in the news. Ryan Lochte having some issues down there. Must be thankfully he's back up here now, but might go back there at some point. But the Brazilian economy shrank 4% last year. That's remarkable, because this is supposed to be a time during which the Brazilians, Brazil is home to 200 million people plus. This is supposed to be a coming out party for them. Hosting the World Cup in 2014, the Olympics in 2016. This was supposed to be a banner period for economic growth in Brazil. Instead, as I say, that economy shrank 4% last year, expected to shrink about 3.3% this year, despite hosting the Olympics. And then there's Russia. The Russian economy also shrank about 4% last year, expected to remain in recession in 2016, and I think you'd agree they deserve that. So wherever you look around the world, it's a pretty spotty checkered record of growth, and in fact America emerges as one of the better growth stories. But the point is this: global growth has been disappointing. And several years ago, the thinking was that this would actually be a quite healthy period for global economic growth, largely because of what was supposed to happen in the emerging world. And so producers around the world, readying themselves for a period of brisk global economic growth, expanded capacity. When the demand does not manifest itself and there is excess capacity as a result, prices must fall. Now, there are a few commodities that are used by all of humanity. Oil is one of them. Oil today, it's true, the price was up to $48 a barrel, but I think you'd agree oil prices are quite low still. Certainly relative to what they were in the summer of 2014 when oil peaked at $107 a barrel, and then certainly less than they were in the summer, early summer of 2008 when oil peaked intraday at $147 a barrel. Of graph for you NYMEX crude oil futures prices in US dollars, but you're familiar with the fact that oil prices continue to be quite low. Now, one of the fundamental tenets of economics is that when price is low, quantity supplied is low. If, for instance, you're a home builder, when do you want to build a lot of homes? When prices are high, and therefore through the provision of a sale, one can cover the cost of land, labor, materials, permitting charges, and still squeeze out some profit margin. When does one not want to build homes? When prices are low. The same economics attaches to oil suppliers, or at least presumably. And yet oil supply around the world is at near record levels. Russia producing 10.4 million barrels of oil per day. Many OPEC nations producing at near record levels. Oil rose today because there's this rumor out there that the Saudis will soon freeze their own production, and many OPEC nations are set to do the same. And we've seen this repeatedly, where the market is talked up because of rumors, and then when those rumors turn out not to be true, prices come back down. But we've been in that range of $40 to $50 a barrel now for quite some time. Now, this puzzles us economists. Why is supply so elevated when price is so low? And one of the other things that we economists presume is rational behavior. Meaning that we expect people to behave in accordance with our models, and when they don't, we get upset. And rational behavior suggests that when price drops, quantity supplied should drop. And this rational behavior assumption is one of sort of the foundational principles of economics. But of course, God created Russians and Iranians, and they don't seem to care so much about profit margins or the laws of economics. They seem to care more about keeping people busy and producing as much oil as possible to add as much to the treasuries, their respective treasuries, as much as is possible. So the goal is to maximize total revenue as opposed to profit. Now, when price falls, perversely, what has to happen to output to stabilize revenues? Output actually has to rise. Now, you might say, well, Anirban, that's fine, but assuredly we Americans are rational. Why are we still producing 9 million barrels of oil per day? Well, many of our companies have debt service. And when you've got debt service, you can't simply drive production and revenues to zero. You don't have the revenues to pay debt service. Somebody else gets your assets. There's no victory in that from the perspective of the owners of the current assets, the current owners of the assets. And so production is very high, and demand growth has been much less than anticipated. If you go back to 2010, 2011, on any given day, the world was using between 3 and 4 million barrels of oil more than it had the same day the previous year. The pace of growth now is about a third of that. So, high supply, disappointing demand, low prices. Now, as you know, this is not relegated to oil. We have seen declines across the commodity complex. Today, copper is trading at around $2.17 per pound. Natural gas is around $2.66 per million BTU. Whether you're looking at precious metals, base metals, or iron ore here in red, commodity prices are low across the board. Which brings me to my next economic principle. When price is low, quantity demanded should be high. So, as had been said during the very nice introduction, one of the things I do is I teach once a year, just to maintain my credentials. At Johns Hopkins University, I teach global strategy. And I teach using case studies. And one of our first case studies, we study at depth, at length, Walmart. We study Walmart. You might ask, well, why would you study Walmart? Because we're trying to understand how a company can orchestrate the global supply chain. It's a remarkable company based in Arkansas. They supply to stores across the United States, including in rural America, on a just-in-time inventory basis. It's sourcing from all over the world. It's really quite remarkable. And so we study that. And one of the things I'll ask my kids, and my kids are bright and they're polite. So one of the first questions I'll ask in the course is, what does it say on the front of every Walmart? And my kids, you know, being polite, they raise their hands. It's very orderly, it's very civil. A rarity in America these days. And I'll call on them, you know, maybe Jeffrey in the second row. Jeffrey, what does it say on the front of every Walmart? Professor, it says Walmart. And that's a good answer, as it turns out. That's correct. And full marks to Jeffrey. I give 10% for class participation. He gets all of them. And I'm so glad the admissions committee saw fit to admit him. But my real question, of course, is what else does it say on the front of every Walmart? And the other thing it says is always low prices. Many of us have been to Walmart. None of us admit it. But we don't go for the experience. We go for the low prices and the product availability. You might remember growing up, maybe it was us, maybe it was our parents, we would wait for the sale at JCPenney's, or at Kmart, or at Sears, Roebuck and Company, or if we're very unfortunate, Montgomery Ward. But when Walmart came to town, you didn't wait, you just went. Always low prices. And so there's an opportunity here for the producers of the world to buy iron ore cheaply, copper cheaply, natural gas cheaply. The game in capitalism is actually pretty simple. Buy low, sell high. That's it. There's nothing else to the formula beyond that. Difficult to operationalize. But buy low, sell high. That's the recipe. If you do that enough times, you can run for president as a Republican. So the question then becomes, are the producers of the world taking the opportunity to buy low? And we know they're not. How do we know? Because we can see how much copper is being consumed worldwide, how much natural gas, how much oil, how much iron ore. But we also have leading indicators like this one, the Baltic Dry Index, which gives us some insight into the amount of inputs that are being purchased by producers around the world. Now the Baltic Dry Index is an index, a leading indicator for the global economy that has enchanted me for years, in fact decades. So interesting have I found the index to be that when I was a single man in the 80s and 90s, I would often introduce the index into my conversation with young women in an attempt to garner interest. And it might surprise you to learn that very little interest was garnered. That, I spent a lot of time by myself during the 80s and 90s, eventually gave up and got married. And for a long time actually held the index as culpable. Later in life was told by others that in fact other forces at work, and it really wasn't the index. The index in fact is a fabulous tool. I've defined it for you at the bottom, but that's irrelevant because you can't see it. But let me read this. The Baltic Dry Index, or BDI, is a measure of the price of shipping major raw materials like grains, metals, and fossil fuels by sea. So this is a reflection of shipping charges, but not all shipping charges, just for those items that serve as inputs to production. Metals, grains, fossil fuels. And what you see here, or not see here, the shipping charges have collapsed. Why is that? Because the ships are empty in many cases. Now some of you will point out to me that that's because we have added to the global fleet a lot of very large containerized cargo ships because of the expansion of the Panama Canal. True, but the owners and operators of those ships did not expect them to be so empty, and therefore for pricing power to be so weak. And why is this a leading indicator for the global economy? Because if producers around the world are not buying inputs to production today, what does that tell you about global output tomorrow? It will also be weak. And again, this has a lot to do with the fact that nations that we thought were going to drive the global economy forward are simply not. Brazil. Now, you may not be able to see it, but I've graphed the Brazilian real, their currency against the dollar. Here, the real was down 33% against the US dollar last year, triggering a massive inflation problem. Food, transportation prices, housing-related costs. By the way, the same thing is happening in England right now because the pound has fallen from $1.50 down to around $1.32 today, so inflation is beginning to manifest itself there. Things are so bad in Brazil that Standard & Poor's and Fitch Ratings recently downgraded their sovereign debt to junk status. Again, this is the giant of Latin America, and the world was expecting the Brazilians to boom at least several years ago. That has not happened. In fact, they've been quite a drag on the global economy and on the Latin American economy in particular, Russia. Another one of the BRIC nations. The ruble last year fell 20% against the dollar. There's not, you think about Russia. I mean, you think about a few years ago, them flexing their muscles, riding naked on horseback through Ukraine. I don't know if you've seen the most recent pictures, the muscles have become decidedly flabbier. And that has a lot to do with the fact that there's not much to the Russian economy beyond oil and natural gas. Ask yourselves, how many of you wear Russian shoes? How many of you drive a Russian-built automobile? Or want to fly in an airplane assembled in Chernobyl? Precisely. Besides oil, natural gas, and defense goods, there's not much in the Russian economy, and those prices have collapsed. And of course, that economy has been impacted by sanctions imposed upon them for their episodes in the Ukraine, and then China, where much of the pain has been in equity markets. So if you've been invested in the Shanghai Exchange, you've taken a beating since mid-2015, mid-2014 actually. And stock values fell 12% just during the first week of 2016 trading, and capital will go where it's best treated. And when you suffer 40% or more losses on the Shanghai Exchange on a year-and-a-half basis, that capital is going to flee that society, and I'll talk about the salience of this for the US economy as I go through the presentation. Now, what have I said so far? Global economy is weak, and global economy is positioned to remain weak. And that's not just because of Brexit and some other things that have happened recently. That is a longer-term phenomenon. But we as Americans can take some quantum of solace in the fact that at least the US economy continues to expand. Not rapidly. We just got data for the second quarter in terms of gross domestic product. GDP growth is the broadest indicator of US economic progress. Second quarter of 2016, the US economy expanded just 1.2%. Expanded about 1% during the prior 2 quarters. For the last 3 quarters, America has expanded about 1% on an annualized basis. That's it. Almost making us wish for the good old days when we were growing at 2%. It's been a really weak economy. But it is a recovery. America's not in recession. We are growing economically. Many of your firms have significant backlog. You're busy. Your biggest problem is finding workers. Isn't that true? And that's a reflection of the fact that the US economy is now in its 8th year of economic recovery. We are now in the midst of one of the lengthiest recoveries in US economic history, believe it or not. The lengthiest recovery in US economic history occurred between March of 1991 and March of 2001, precisely 10 years, 120 months. We're already in year 8. 7 years and 2 months have been completed. So there is growth, and that raises the question, to the extent that the US economy is growing, what's driving us forward? This slide tries to get at that. Now again, too many data on here by half. This is GDP growth for the last 4 quarters. So you can see, again, the last 3 quarters have been very weak. These 4 categories are the components of gross domestic product. Again, you may not be able to see this, but the 4 components are, this first set of bars, personal consumption, that's consumer spending. Second set of bars, government spending, that's public sector spending. Third is net exports, that's exports minus imports. Exports, what we produce in this great country but sell abroad, minus imports. And then this 4th category is gross investment, which among other things includes construction spending, both residential and non-residential. So, what these bars show is the contribution of each of these categories to GDP growth. If you were able to see it, and if you're able therefore to add up the numbers attached to these purple-colored bars, the purple-colored bars denote that second quarter of 2016, if you're to add up the numbers attached to these bars, you would get this 1.2%, the overall economy. So I'm just decomposing the economic growth for you. There's only one category you can see, perhaps, that is expanding, and that's consumer spending. That's what this says. There is nothing else really happening in America beyond the expansion of consumer outlays. That's it. Now you knew before you got here this is a consumer-led recovery. This is how we economists make that point. It is not a government spending-led recovery. Government is not investing. Do you see government in any major way addressing America's infrastructure deficits? You do not. We'll talk more about this as we go through the presentation. It's not net export-led recovery. Exports shrank in this country 4.8% last year. Global economy is weak. And dollar actually has been a bit stronger, at least a bit stronger now than it was 2 years ago. The euro got stronger today, can now buy $1.13, but look back 2 years. 1 euro could buy $1.38. The British pound, as I say, can only buy $1.32. On the day of the Brexit vote, which was June 23rd, 1 pound could buy $1.50. The yen is still about 100 yen to the dollar, but the US dollar has become much, much stronger against the Canadian dollar. They're our leading trading partner. And so with the global economy weak and the dollar relatively strong, export growth is weak. That's not been a contributor to growth. And then this is gross investment. And one of the things that's been happening, in part because the global economy is weak, is US corporations on average have become less profitable. Corporate profits are down about 3% on a year-over-year basis. And when corporations become less profitable, they don't invest. Is anyone here from Verizon? Is anyone here Verizon? Are you represented in the room? Okay, good. We can talk about Verizon. So Verizon is a humongous company. If you look at their balance sheet, it's the size of a country. It's just massive. And they're, you could argue, a technology company. So they have a lot of impact on our shared broadband speeds, the quality of our phone service, whether we drop our calls, all these kinds of things. So, and they have billions of dollars in cash on hand. So they could invest that money in mainstream economies, expand broadband speeds, better phone service, all those things. But they just spent $4.8 billion on what? Yahoo. They bought Yahoo, a wasting asset. And probably they shrink Yahoo a little bit. They'll pay the CEO of Yahoo, Marissa Mayer. If they fire her, they have to pay her $200 million. I don't know how that benefits a shareholder, but that's the nature of what happens in America. But it doesn't translate into investment. It translates into a really big house for Marissa Mayer. And so that's where we are right now, leaving us that much more dependent upon personal consumption to drive the U.S. economy forward. Now here's the good news. There's no reason to think that the consumer won't continue to spend. Why? Because more of them are working. Got the jobs data for July. In July, the nation adds another 255,000 net new jobs. We've added millions of jobs. I know there's a lot of skepticism regarding unemployment rate data. So when I say the U.S. official unemployment rate is 4.9%, you say, ah. But the fact of the matter is, you can't find good workers easily. That's true. The labor market has tightened up. And that, in part because over the past 1 year, we've added more than 2.4 million jobs. And then, by the way, it's not just construction. Several weeks ago, I delivered a presentation to the New York State Motor Truck Association in Buffalo, New York. That's how glamorous my life is. And they'll tell you the same thing. We can't find drivers. So here I've just broken down the economy by job growth. So as an example here, the segment called Education Health Services supports 639,000 more jobs than it did a year ago. And Professional Business Services supports 550,000 more jobs than it did a year ago. This category here is leisure and hospitality, that's tourism. Mostly hotels and restaurants. Adding a lot of jobs. No surprise, consumers are spending. Taking more vacations. Hotel occupancy rates are up. We'll talk about hotel construction later on in the presentation. That's added 421,000 jobs. And you do not need an economist from Baltimore to tell you that the consumer is spending. You can see it yourselves in the malls, the outlet centers, online, the auto dealerships. We've been posting record auto sales recently in this country, new car sales. And where I really see the appetite to spend, where I see Americans spending with least hesitation, the full-service restaurants. Sir, go tomorrow to an Applebee's. Now, don't eat there, you're better than that. But go there from the perspective of doing some primary research. It'll be busy, as will the Olive Garden next door, the Steakhouse on the street. The Chipotle's will be slammed, I can assure you, even though it probably should not be. I even saw someone last week go into a Red Lobster. So the consumer is pretty engaged in this economy. And then, of course, the segment in which we have most interest is construction. That's at 215,000 net new jobs over the past year. If you could see the tabular data here, you would see that that 215,000 jobs that we've added over the past year translates into 3.3% job growth. In other words, we employ in America 3.3% more construction workers than we did the same time last year. And that's amazing given the fact that it's hard to find any construction workers out there with the right set of skills and, of course, work ethic to work the job and show up on time, to show up at all. We added another 14,000 net new construction jobs in July. Generally speaking, it's been a good news story for the economy. You might ask the question, well, Anirban, where have these jobs been added? I'm glad you asked. This is state-by-state growth in construction jobs between June of 2015 and June of 2016. Virginia, 1,400 net new construction jobs added over the past year. I'll show you more Virginia data in just one moment. Number one state in terms of adding construction jobs is California, followed by Florida. There are 5 states that were hardest hit during the foreclosure crisis, where home prices really fell and where disproportionately, a lot of people fell underwater on their mortgages. Those 5 states were California, Florida, Georgia, Arizona, and Nevada. You'll see California, Florida, Georgia, Arizona right here, among the leading states in terms of construction job growth now. Those housing markets have stabilized. Nevada is right here, adding 6,000 construction jobs over the past year. Where do we not see job growth in construction? North Dakota, Kansas, also Alabama, West Virginia, Wyoming, Montana, Alaska, Arkansas, a lot of these are natural resource intensive states. These are states that suffer most when commodity prices fall. Oil, natural gas, corn, wheat, so on and so forth. Now, Virginia. Now this is Virginia non-farm employment. Again, the horizontal bars represent the change in employment supported by each category over the past year. Again, this is June versus June. So Virginia is doing just fine. The Commonwealth has added 1.9% to job totals over the past year. During the same period, the nation added 1.7% to its job totals. Again, here's that construction reading, that 1,400 jobs I showed you on the previous slide. But we can get more granular here, that's statewide. What about Northern Virginia? 2.5% job creation, 35,400 jobs over the past year. Not bad. Not bad, not bad at all for Northern Virginia. What about Richmond, which has become red hot all of a sudden? Millennials moving to Richmond in very large numbers. Richmond is hot. 24,400 net new jobs, 3.7% job growth. Richmond is adding jobs at twice the rate of the country has been over the past year. What about Lynchburg? 400 jobs, 0.4% job totals. Not as much going on. Mostly people look out the windows here. Apparently not a lot of hiring taking place, but still job growth. And number one category, by the way, is leisure and hospitality. Again, those restaurants and hotels. Construction, according to the official data, has actually lost 100 jobs over the past year. But now, what about Virginia in comparison to the balance of the country? Well, again, just getting a little bit more granular about that. This is percentage job growth for the 50 states and the District of Columbia. So Virginia ranks 18th with that 1.9% job growth. The fastest job growth is in Oregon, followed by Utah, and some sort of very interesting stories here. You look at this list, Delaware, you know, a lot of these places like Portland, Oregon and Provo, Utah, it's about young people moving there and the economy is sort of gaining steam because young people are moving there. Delaware is because older people are moving in large numbers to Sussex County, Delaware. That's Rehoboth and Bethany Beach, that area. Only 2 states in the country have both an estate tax and an inheritance tax. That's New Jersey and Maryland. And sitting in between right there is Delaware with its beaches. So that's one of the reasons you see that. Florida, obviously a lot of baby boomers moving to Florida. Arizona, another retirement hotspot. California with its technology segments. Atlanta, Georgia is booming again because a lot of millennial movement there. Seattle, Washington. So all of that makes sense. But then you get to number 9 here, Idaho. Idaho. Now, I don't know if you've ever been to Idaho. It's a beautiful state. And also, it's fun to say the name of the state, and if you say it properly, it's self-deprecating. And so that raises the question, why Idaho? Why Idaho? And so I'm so glad you asked that. And somebody said it actually, it's Boise. Boise is booming. Boise is simultaneously its state's largest city, its state capital, and its biggest university town. That's a great formula. The University of Idaho, as it turns out, is in Moscow, Idaho, but Boise State, of course, is in Boise, and Boise State's really a big place. A lot of those kids hang around. So Boise is booming, millennials are moving there, and so you see a lot of apartments being constructed, a lot of job growth generally. And you see that in some of these other markets too. Greenville, South Carolina, Columbia, South Carolina, Charleston, South Carolina, all attracting a lot of millennials. Denver, Colorado, Denver is booming. A lot of young people moving to Denver, often for the wrong reasons, but the fact that they're there drives a lot of economic activity. Now, where do we not see job growth? North Dakota, Wyoming, Louisiana, and this, of course, is before the floods. West Virginia, Oklahoma, Alaska, Kansas, again, the natural resource-intensive states. The states that suffer when commodity prices are low. Again, natural gas, oil, wheat, corn, whatever happens to be. In fact, according to the Moody's Economy.com analysts, 5 states, Alaska, Louisiana, Wyoming, North Dakota, and West Virginia, are already in recession. These state economies are actually shrinking right now. Virginia and my state of Maryland are in this blue color. The Moody's analytics folks believe that these states are therefore recovering, meaning still not fully recovered from the Great Recession. And this state's unemployment rate continues to be well above what it was pre-recession. The same is true for Maryland, but on the path to recovery. The states in green, by the way, are not in recession, not at risk of recession, and also have more than fully recovered from the Great Recession. This is unemployment rates, just to show you some unemployment rates for the 20 largest metropolitan areas in the country. For those of you tied to the Washington metropolitan area economy, there might be a couple of folks here, maybe more than a couple, continues to have one of the lowest unemployment rates in the country. Washington has gotten through sequestration, and that economy is actually doing quite nicely. It has added more than 80,000 jobs over the past 12 months, the region. The number one rank here is Minneapolis. They have the lowest unemployment rate among the 20 largest metropolitan areas in the country. Now, no one ever talks much about Minneapolis. Even though it is one of the largest communities in the country, more than 3 million people live there. And one of the reasons for this, the fact that Minneapolis almost never comes up in conversation. When was the last time you were talking to somebody and Minneapolis came up in your conversation? Never happened. And one of the reasons for this is because their sports teams are so bad. The Twins, the Vikings, the Timberwolves, the Gophers, almost all uniformly horrific on the fields and in the arenas. These are some of the most uncoordinated people in our country. But they have produced companies like Best Buy, Target, 3M, Cargill, General Mills, United Health, Wells Fargo, who represented here today, as it turns out. Wells Fargo was founded in New York, but Norwest, the acquisition in the 80s, I believe it was, forms a big chunk of that banking capacity. St. Paul companies, and then, of course, the Mayo Clinic. It's just a fabulous regional economy, and continues to boast the lowest unemployment rate among the 20 largest metropolitan areas in the country. Let's talk about real estate and construction now. The data in which you have most interest. And I will start out this part of the presentation residentially, and then I'll move to non-residential. So, one of the values that, or sources of value that we economists can create is by being predictive and by getting things right. I have been told, because I spoke to this group 6 years ago roughly, that I was pretty right about what I said back then. I don't remember what I said back then, but I'm happy you remember, so long as you believe I was correct. But I'll tell you one thing about which I was not correct, and that is the direction of interest rates. Because, generally speaking, as an economy recovers from a recession, I mean, see, during the recession, the issue is that quantity demanded of various things is falling, and the quantity supplied of various things has not begun to adjust. So there is excess capacity, excess supply. To re-equilibrate markets, prices fall, and when prices fall, that results in quantity supplied falling, and quantity demanded rising again, as consumers, for instance, take advantage of those lower prices, and equilibrium is reasserted. It's a painful period of adjustment, but that's how we get back to equilibrium. The price of money is the interest rate, or interest rates. And so one would think that after 7 years of economic recovery, money, like any other commodity, would be more expensive. But in fact, interest rates have been falling for much of the past 7 years, mortgage rates included. Here I'm showing you the 30-year fixed mortgage rate in blue and the 15-year fixed mortgage rate in red. We have a 15-year fixed mortgage rate below 3%, a 30-year fixed mortgage rate below 3.5%. These data come from Freddie Mac. Now, if you think about it, this is your recipe for a housing market boom. What have we talked about? Fair amount of job creation, average hourly earnings are up 2.6% on a year-over-year basis, and really cheap money. That's your recipe for an owner-occupied housing market boom in this country. And instead of buying homes, people of course have been renting. And as you recently heard, at 63.1%, the US homeownership rate is now at a 50-year low to 51 years. That's remarkable, and that's something I would have predicted. If you take this line and you flip it upside down, you see what's really come back residentially? It's multifamily construction. 10, 11 years ago, you see this peak in multifamily construction about a decade ago. Multifamily, not single family, multifamily. This is mostly condominiums. Still the ownership society back then. This new peak here, multifamily construction, that's apartments. And we know, because you can see what's being built, whether it's for rent or for owner occupancy, but also, if it weren't apartments, homeownership wouldn't be diving in America. Now, you watch. Over the next decade, homeownership is going to come back in America with a vengeance. People will be racing to buy homes in this country. It'll happen, not immediately, but at some point over the next decade. Why would I say such a thing? Because demographics is destiny. The most common age in America today is the age of 24. We have more 24-year-olds than any other age. It's annoying, I know. I hear you. I hear what you're saying. The second most common age is 25. Third most common age, 23. We've got a lot of 20-somethings. Now, several years ago, these kids were locked away in their parents' attics. Some of them are actually moving out and forming households and renting apartments. Generation Y, the millennials, are often defined as being born between 1980 and 1999. So after their birthdays this year, they'll be between the ages of 17 and 36. So the central tendency of that generation is in the mid-20s. A lot of renters. In 10 years, that generation is now centered around the mid-30s. And a lot happens during those 10 magical years. People have children. They get married, often in order. And all of a sudden, renting may not be their best option. And moreover, home prices are now rising based on Case-Shiller and other data. So the investment motivation in housing is now returning. Particularly in markets like Dallas and Denver, where prices are up more than 9% on a year-over-year basis. And so that's one of the things to watch for going forward. And in fact, I think that in many urban areas, by that point, you will see that there's way too many apartments, and then apartment rents will actually begin to fall. And in some of those markets, you might start to see condominium conversions on a fairly large scale, which is actually exactly what we saw 10 or 11 years ago. And now finally, turning to non-residential data. Now, hitting the home stretch of the presentation, thank you for sticking with me. This is almost everyone's favorite leading indicator for commercial construction in America. The Architecture Billings Index, produced by the AIA, the American Institute of Architects. Any number above 50 means that architects are busier this month than they were last month. Lately, the numbers have been about 50. That matters. If architects are getting busier upstream, contractors will get busier downstream. And the readings have been actually quite good recently. Now, if you look at overall non-residential construction spending in America, non-residential, you'll see that it has really flattened out. If you look at the spending data, it looks as if the recovery in non-residential construction spending has stalled. But really, it's a story of two segments in some sense. There are 16 categories that make up non-residential construction in our country. And when I say stalled, I'm talking about these last few readings here. See how flat line that is? There are 16 categories that comprise non-residential construction in our country. They are reflected on this chart. These horizontal bars represent the percentage change in spending by category. Let me start at the bottom. So these are the categories where spending is actually down on a year-over-year basis. Sewage and waste disposal, down 14.5%. Water supply, I had thought that was going to be a big winner because of Flint. But instead, water supply-related spending is down 14%. Public safety, that's prisons, jails, fire stations, police stations, down 8.4%. Highway and street, down 5.9%, despite the fact that we passed a federal highway bill last year, the FAST Act, signed on December 6th of last year. That's down. Education, which is heavily financed by the public sector, down 4.3%. And then transportation, which includes, for instance, mass transit systems, down 3.3%. All those categories I named are heavily publicly financed. That is the reflection of that lack of public sector or government spending. And not just federal spending, state and local government spending as well. The state of Illinois can't even pass a budget. Now, what's at the top? Where do we see the growth? Number one category, office space. Growth in office space related construction, 16.2%. Lodging, that's hotel rooms, up 16.1%. Why is that? Why is that? Why do we see? Because I think it's the foreign investor. That we have a lot of foreign money flowing into these shores. Well, let me just show you the slide. So this is offshore investment sales volumes by year from 2003 to 2015. The foreign investor has nowhere else to put their money, or very few options. Where do they invest it? Japan, where they have negative interest rates and the economy is barely growing? Do they put it in Europe, given all the erratic tendencies of equity markets there and negative interest rates there as well? How about England? I don't think so, not post-Brexit. What about Latin America? No, Brazil is shrinking. Venezuela will shrink 7% this year, have about 700% inflation. Can't put it there. What about Africa? Africa does not have the ability to accommodate significant amounts of global capital. India is too erratic. China is too erratic. So it is the United States of America. You can put some money in Canada and so on and so forth, but by and large it's America that can absorb that capital. And it is flowing here in large amounts. It is the tail wagging the dog. We don't need so much office space. But it's being constructed. And that's because foreigners have to put their money someplace, and They look at America and they say, well, the stock market looks expensive. Dow's at 18,600. Bond market looks expensive. 10-year treasuries yielding 1.53%. Bond prices are really high. So interest rates are low. Maybe I'll put the money in commercial real estate, and that's exactly what we were saying. Now that's great in the short term because it keeps contractors busy, particularly in the markets in which foreigners like to invest, which is New York, Washington, San Francisco. Final point as it relates to construction, this is the Inputs to Construction Producer Price Index. This is a reflection of construction materials prices. So for the typical contractor, one would think that labor costs are rising. One of the at least partial offsets might have been that materials prices have been falling. According to the government, materials prices, as reflected by the Construction Producer Price Index, are down 2.3% on a year-over-year basis. So I know a lot of people are fixated on the prices that are rising, like concrete prices up nearly 4% on a year-over-year basis. But crude petroleum prices are down. Non-ferrous wire and cable prices are down. That's a largely reflection of copper prices. Iron and steel prices are down. Natural gas prices are by where they were last year. So we have not seen a lot of material price inflation. Again, that's reflected in those or a representation of those low commodity prices that we see globally. Okay, enough of that. Enough. Let's talk about the forecast, shall we, before the sun completely sets. Now you may or may not realize this. Actually, it's too late, I get it. But you may or may not realize this, but we economists do not have a great reputation for forecasting accuracy. We do our best, but it's tricky. Now, one of the things I have said is that it is a consumer-led recovery. That will not change, not in the near term. It will not be a public sector-led recovery. Yes, there is some talk about, depending on who wins in November, whether she would have a stimulus package, and that's possible. But she would have to get probably through a Republican House of Representatives to do it, and that would be tricky. So it's probably not in the near term at least going to be a public sector-led recovery. It's not going to be a business investment recovery. CEOs seem very skittish, underconfident, more interested in buying back stock using low interest rates to leverage and maybe raising dividends, but not really investing in the Main Street economy. It's risky. And I don't think net exports is going to be a source of growth because the global economy, I predict, will continue to be quite weak. And in fact, it would not be surprising to me if the IMF revises downward its forecast for global economic growth a fourth time later this year. So that leaves only the consumer. Now the good news is the consumer continues to spend. It should be noted that 2/3 of consumer outlays is on services, things like medical care, vacations, entertainment. 1/3 is on retail goods. And here I'm showing you retail sales growth or shrinkage by category. So at the top, and these are July versus July data, July of 2015 versus July of 2016. At the top is internet retailers. Their sales up 14.1%. That includes, of course, Amazon.com. What Jeff Bezos has created, graduate of Miami Palmetto High School, just an average guy. What he has created is just miraculous. Second is health and personal care stores. Americans are obsessed with wellness. We now, in fact, have wellness centers, places where apparently you can be just well. Go there and be well. And one of the things that Americans love to do to be healthier is we buy Fitbits. Americans buy Fitbits to get healthier. They slap them on their wrist, but what they really tend to show is how little we move. And in fact, after they buy their Fitbit, they eat and they drink. This is food services and drinking places. And one can only hope that they walked to the restaurant. The point is here that for the most part, in most categories, we see spending growth. And the consumer continues to be engaged. Total retail sales are up 2.3% on a year-over-year basis. The index of leading economic indicators, my penultimate slide, also suggests that a near-term recession is unlikely. The readings are skittish. These last few readings here are a mix of positive and negative. We saw that back in 11 and 12. Did not signal a recession, just very weak economic growth ahead. I do not expect the U.S. economy to manage to grow 2.2% this year. I think most likely is around 1.5% to 2%. That's where we're going to end up for the year. And then most economists continue to overestimate the strength of the U.S. economy. One of the things that we have seen, parenthetically, is that the typical American worker is less productive now than they were a year ago. The typical American worker produces less on an hourly basis than they did a year ago. And there's all kinds of forces at work there. But what's really happening is that disproportionately we in America are creating low-wage service sector jobs. So I've said that we're creating a lot of jobs, and we are, but not a lot of high-paying jobs. And this shows up in all kinds of ways, including stagnant incomes. But in any case, for right now, it's a consumer-led recovery, and that consumer-led recovery will remain in place. My final slide. So, not a happy new year so far for the global economy. Everybody knows about China and Brexit and North Korea and geopolitical issues, but we have problems right here in America. Corporate profit margins have been slipping. And notice that even in your industry, for the most part, profit margins never got up to, nearly up to where they were prior to the recession. They have sort of grudgingly edged higher, but it's, in many industries it's even worse. They're actually shrinking. And inflationary pressures are building. We're running out of workers to hire. And so that does not sound like a great recipe for stock prices or for corporate investment. I know what you're going to say, Anirban, the stock market's hitting record highs. That means nothing to me in terms of helping me forecast the economy. Before the recession, the all-time high of the Dow Jones was achieved on October 9th of 2007. The Dow that day closed at 14,164.53. Within 2 months, we're in recession. So these things turn around very quickly. That's one of the reasons that economists never forecast recessions, is because they always assume the economy is going to be the way it has been. They don't see the turn. But I think that asset prices have become somewhat inflated. It's hard to justify current stock prices given earnings, and it's hard to justify commercial real estate valuations given how much income they are producing. Only the consumer is really contributing meaningfully to growth. As I say, the good news is job growth should remain decent in the near term. We ended 2015 with a near record in total job openings, and the number of job openings continues to be quite high, including in construction. But a lot of foreign money is flowing into America, and ultimately that may prove to be the current recovery's undoing. One of the conventional wisdoms is that, well, this time is different. Last time we got into trouble because banks were lending too much money. Banks are not doing that anymore. It's hard to get money now from the banks. Yes, it's true. Let's say from a typical commercial real estate developer, they demand more equity in the deal. But when foreigners are pumping so much equity into commercial real estate in America, there's your equity to unleash that debt. And on top of that, we've got a lot of consumer debt. 85% of all car purchases are financed in this country. And the growth has really been among the subprime auto borrower. That's where the growth has been, people with low credit scores. Because how am I going to expand sales? I've already sold cars to the people with good credit. I've got to expand now to folks with poor credit. Same has happened with credit cards and other debt instruments. And in fact, I think we might be transitioning very quickly from the mid-cycle stage of the recovery, which is the fun part. People get busier, the backlog is high, and they feel confident, to the late stage, meaning the period that immediately precedes the next recession. In my mind, the 2017-2018 economic outlook is quite murky, so I hope you'll invite me back and we can talk about it. I thank you very much for the opportunity to be with you tonight. It's been a privilege. Thank you. Right, so any questions here? Yes, sir.
Yeah, how do you explain the 30-plus year bull market in treasuries, the long bond, and why does it seem like no matter what the economic cycle, the yields continue to get lower? And is that foreign investment? I mean, what does that mean to you in terms of forecasting future economic performance?
It's a great question, which I say to everybody. So please don't infer anything from that. But his question is, look, you know, you look at the rate on the 30-year bond, or the 10-year bond, or the 7-year, or the 5-year, it's low. And what does that tell you as an economist? That is the question.
Right.
And here's the thing people will say. People will say things like, you know what, there's a lot of money sitting on the sideline, meaning in cash. And that's true. And then they'll say, well, and there's a lot of money sitting in bonds, you know, fixed income instruments, helping to explain why interest rates are so low, negative in certain parts of the world. And that's true. And there's a lot of money sitting in stock, helping to explain why stock prices are at record highs. And there's a lot of money in real estate, helping to explain why construction is rising, at least in certain categories. And there's a lot of purchases right now of real estate, you know, a lot of volume in terms of sales. What does that tell you? There's a lot of money everywhere. The world is awash in money. And why is that? Because central banks around the world have made it their business to expand money supply everywhere. Now, they've done this for various reasons. One of them was to rebuild asset prices, rebuild wealth, get the housing market back in shape, whether in Europe or America or wherever it happened to be. But when you've got that much money, that's when people make mistakes. That's when they overinvest, overbuild. whether it's in .com stock or in commercial real estate, think late 1980s, whatever it happens to be, or homes in the 2000s. And that's my fear, is that central banks have created so much money supply that asset prices are being artificially bid up, that the rents don't justify the sales price of that apartment building, that the lease rates don't support the purchase price of that office building, and that eventually assets begin to underperform because people bought this high and they can't justify it, and so people take write-downs because that real estate loses value as we get back to equilibrium. And what would cause, for instance, the US Central Bank, the Federal Reserve, to start to raise rates? Inflation. Mm-hmm. And we are at 4.9% unemployment nationally. We'll probably be at full employment sometime next year. At some point, they're going to have to start raising rates. And yes, the stock market, has done very well in part because there's been bad news in the economy, suggesting that the Federal Reserve would not raise rates. Mm-hmm. But at some point, inflation will rear its ugly head, particularly wage inflation. And by the way, $15 an hour minimum wage in New York, $15 minimum wage in California. And these things are starting to catch up to people. The median wage nationally is $17.40. So some of these states now have minimum wages that's quite close to the median wage nationally. That's inflationary. And as you know, it's not just the minimum wage worker who's affected. Because if I am making, let's say, the minimum wage in my state, Maryland, is now $8.75 an hour. So if I make $11.75 an hour, I'm making $3 more than the minimum wage worker. When our minimum wage rises to $10.10 an hour a couple of years from now, I want to be making $13.10 an hour. I still want to have that gap between me and the minimum wage worker. It affects a large part of the wage scale. That's coming. And I think low interest rates have really kept these asset valuations high. Take that away, we've got a big problem. And then on top of that, consumers are spending more, not because their incomes are growing by leaps and bounds, as you know they're not. They're borrowing more money in many cases, including student loans and other forms of debt. That's what I'm worried about, and that's why I say the 2017-2018 outlook is very murky, because asset prices can shift very quickly. And I think at some point they will begin to do that. Yes, sir?
Are fears about the level of national debt legitimate? Is that a legitimate concern?
Oh, yes. And it might surprise you, his questions about the national debt, it might surprise you that an economist would speak for almost 50 minutes from sunlight to nightfall without mentioning the national debt even one time. But that's because my forecast horizon is very short. It's 1 or 2 years with you. The national debt is not a problem today. How do I